Multinational operations and currency translation. When a company operates across borders, its performance is exposed to more than business risk. Currency becomes a factor. Revenues may be earned in one currency, costs incurred in another, and financial statements reported in a third. Before numbers can be combined, foreign results must be translated into a common reporting currency. The key question is not where the company is located, but which currency best reflects its economic environment. That currency drives how translation is performed. The choice determines whether exchange rate changes quietly accumulate or flow directly through reported performance. When a foreign operation functions independently in its local environment, translation treats currency changes as balance sheet effects. Assets and liabilities are translated using current exchange rates. Income is translated using average rates. Any imbalance created by exchange rate movement does not affect reported earnings immediately. Instead, it accumulates in equity. This approach smooths income but allows currency effects to build quietly over time. Reported profitability appears more stable, even though economic exposure still exists beneath the surface. When a foreign operation is closely tied to the parent, translation works differently. Monetary assets and liabilities are remeasured using current rates, while non-monetary items remain tied to historical values. Exchange rate changes now flow directly into reported earnings. This creates volatility. Income becomes more sensitive to currency movement, even when operations are unchanged. The business did not suddenly become riskier. The reporting framework changed how that risk appears. Understanding this distinction is essential when comparing firms operating across borders. The deeper lesson is that translation methods shape perception, not economics. Currency risk exists regardless of how it is reported. Some methods defer its impact. Others expose it immediately. Analysts must look past reported volatility and identify the underlying exposure. Comparability across multinational firms requires adjusting for these effects mentally, if not numerically. Without understanding currency translation, reported stability or instability can be mistaken for operational strength or weakness when it is simply accounting presentation.